Hi, my name is John King with Summit Funding, and I've been asked to put together some numbers on what a buy down would look like if we got a seller credit for a home at $438,000 and had the seller credit pay for the closing costs, but then look at another scenario where we do what's called a temporary rate buy down, and it is really a phenomenal option. Let me show you how that plays out. So first of all, this first column says, hey, if we just do a normal FHA loan, and you get a 3% credit from the seller. So the price of the home is $438,000. Your down payment and closing costs, because the seller pays the majority of the closing costs, is just under $17,000. Today's rate's 5.75. So that puts you at about $3,350 a month. But here's the cool thing. If we do what's called a 2-1 buy down, we have three columns here that are exactly the same loan. This final column is what the payment and rate are going to be for the entire 30-year term. But during the first year, we're lowering that rate from 5.75 to 3.75. And then during the second year, it bumps up and it goes to 4.75. And then forever, it stays at 5.75. Now, let me be super, super clear. This is not an adjustable rate mortgage. It's a 30-year fixed rate mortgage, but the seller is giving you an additional credit on top of paying the closing costs. They're giving you an additional credit to pay for the 2% reduction in rate for the first year and the 1% reduction in rate for the second year. And that extra credit has to get paid for. So I'm building that into the purchase price. So what you notice is that the price is raising from $438,000 to $452,000. So that's how we're paying for the reduction in your monthly payment. But let me say one more thing super clearly. Every reasonable expectation is that we are going to be in a recession in the next 2 years. Now, there's no guarantee of that, but everybody expects that because the Federal Reserve is raising short-term interest rates so quickly that it is pushing the economy towards a recession because it's slowing down the economy in order to stop inflation. Well, what happens in a recession is interest rates go down. So we don't see a drop historically in home prices during recession. We see a lower interest rate, and that's what we expect to happen sometime in the next couple of years. But there's no guarantee rates are going to fall, which is why you still have a fixed rate at 5.75. Just like if you did this first scenario, you're at 5.75 forever. Here you're at 5.75, you're just temporarily at 3 or 4.75%. But here's what it does. In the first year, it saves you $427 a month because your payment drops from $33.56 to $29.29, and your cash to close is about the same. Then the second year, it drops you to 160. It lowers you 167 compared to your initial payment. So your payment goes from 29 to 31.90. And then for the third year and beyond, the payment is a little bit higher than where it would have started because your loan amount is bigger, because you borrowed more money, because you bought at a higher purchase price to pay for these two rate reductions. But the bottom line is that you can choose to pay the $33.50 every month starting right now. But my recommendation, especially given where we think interest rates are headed, is to take the lower monthly payment for the first year, a reasonably lower monthly payment for the second year, with the expectation that by the third year, we likely will be able to refinance you. Again, there's no guarantee we can refinance. That's not a bad payment compared to your initial payment of what it would have been. So if rates do continue to skyrocket, you're not that far off compared to your original monthly payment that you were going to pay anyway, but it front loads or gives you a pretty significant amount of monthly payment savings now, and then the likelihood we'll be able to refinance you soon thereafter. Thanks so much, and let me know if you have any questions at all, and I look forward to taking great care of you. Bye-bye.